Good morning and welcome to The Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show today, Bryden Teich, CIO and Portfolio Manager at Avenue Investment Management. He's with us for the hour. And in 20 minutes, we're talking to Preet Banerjee, founder of Your Money Degree, about crypto literacy. Then we're breaking the latest retail data with Randall Bartlett, Deputy Chief Economist at Desjardins. And we want to hear from you this morning on First Call. Reach out with your questions on stocks. We'll have Bryden answer as many of them as he can at the end of the show. The number to call, 1-855-326-6266. We'll open the phone lines in about 30 minutes. And our email address is firstcall@bellmedia.ca. Now, some of the stories we're tracking for you in the BNN Bloomberg newsroom. U.S. President Donald Trump has rescinded the invite for Prime Minister Mark Carney to join the Board of Peace, a U.S.-led effort to oversee the reconstruction of Gaza after years of conflict. Trump made the announcement in a Truth Social post. The invitation withdrawal comes days after Carney delivered a speech at the World Economic Forum, warning against coercive tactics by the world's great powers. China's ambassador to Canada says allowing a limited number of Chinese electric vehicles into the country could lead to new auto jobs and cheaper cars. The comments come as Ottawa faces criticism over a deal signed by Prime Minister Mark Carney and Chinese President Xi Jinping. Ontario Premier Doug Ford recently urged Canadians to boycott all Chinese EVs. Ford says the vehicles put thousands of auto sector jobs at risk. Shares of Intel have plummeted in the pre-market. Look at that, they're down by 13% right now as the company struggles to keep up with surging demand from AI data centers. Intel also issued profit and revenue forecasts for its current quarter that were below expectations. The chip maker cites manufacturing problems and supply chain constraints. The decline follows a strong 2025 when Intel stock rose nearly 50%, boosted by major investments from SoftBank, NVIDIA, and the U.S. government. And now our top-line story. That speech, the one from Mark Carney in Davos earlier this week, is still spurring reaction, including from U.S. Commerce Secretary Howard Lutnick. In his own speech at the forum, Lutnick pointed out that the remarks from Carney and what he described as whining from Canada. CTV's Mike LeCouture now on what it could mean for trade and CUSMA negotiations.
Give me a break. They have the second best deal in the world. And all I got to do is listen to this guy whine and complain?
U.S. Commerce Secretary Howard Lutnick called the Prime Minister's speech in Davos political noise. Tuesday, Mark Carney urged middle powers to band together against more powerful countries that use economic coercion. Lutnick warned those words will be remembered during this summer's trade review.
They have USMCA, which means 85% of the Canadian economy comes into the United States for zero. And there he is complaining that he's going to go to China and improve it.
Canada's finance minister pushed back on those comments.
Prime Minister said a lot of things that people thought, and he had the courage to say it loud. I think Canadians have understood by now that diversification is key.
Meanwhile, the reverberations of Carney's message continue to be felt with other world leaders.
I think we have a lot of Europeans who are in this first camp of multilateralism, whereas the American administration is driving multipolarity. And we're trying to make these two things meet.
Australia's treasurer called the speech stunning, adding it makes a powerful point about the old world order being over.
So the job for us, the job for our Canadian friends, is to work out how we can shape all of this change in our own interests.
California Governor and possible Democratic presidential contender Gavin Newsom also praised Carney at Davos for calling out the current state of the world, adding Americans need to do the same. Mike LeCouture, CTV News, Ottawa.
Let's bring in our guest for the hour, Bryden Teich, CIO and Portfolio Manager at Avenue Investment Management. Bryden, thanks as always for joining us. Been a while, but good to see you back here. Quickly, your thoughts on Carney's speech, Trump's retort, and then Lutnick as well.
Yeah, well, I think I echo the comments from the pack. I think like it was a great speech from Carney. I think it's interesting to see how much reaction it's getting because he's basically just describing what is happening. And I think but we did it in a very articulate way. I think that, and again, with everything else that's happened this week, I think it makes it newsworthy. He's just describing what the U.S. is doing and what China has long done, which is essentially flex itself through economic means to get what it wants, to have more power, in the world. And I think to see, Lutnick's comments, and then, it's a kind of a charade at this point. I mean, ultimately, Canada and the U.S., we need to work together. I don't think there was a whining aspect to Carney's speech. He's just describing that countries that are in the middle have to figure out, firstly, their own interests and get those right, and then figure out how, if there's a way for middle powers to work together, because the concept of the UN or the World Bank or the World Trade Organization, these things are not functioning organizations. That's just the reality. And so I think being able to articulate that, or seeing a prime minister articulate that very clearly, I think it frames for Canadians, we do need to figure out what our priorities are. And I think so far, his administration and his parliament is attempting to do that, which I think is a positive.
Could we see a kind of middle country economic union of some type, not just, you have the EU, but from around the world? Or are we too drawn to China and the U.S., especially in Canada?
Yeah, I think we're definitely, the global economy circles around the Chinese and U.S. relationship, and everyone is either then a second or third trader with the U.S. or vice versa with China. And ultimately, that is the core global economic relationship, the U.S. and China, that matters. I think, as we're, in many ways, I do agree with what Doug Ford is saying about Chinese EVs bringing to Canada. I mean, effectively, the Chinese are just producing as much as they can at full blast, and they're trying to find countries to dump it on. And so, not to say that there aren't agricultural exports from Canada that China needs, and there's some sort of balance there. Ultimately, we need to get to a path to working productively with the Americans. Is it going to be in this administration in the U.S.? Maybe, maybe not. But I don't think Canada can go too far into a different reality that doesn't involve having a core economic relationship with the U.S. And it would be, as a Canadian, I think we would all appreciate if there was a little bit more sort of level-headedness from their side on this. Yeah. But clearly, Canada and the U.S. need to be partners.
Maybe there's some level-headedness behind the scenes with other players involved in it. But I mean, we just saw he disinvited Carney from his board, the Board of Peace. And all this, of course, is shaping up as we head into CUSMA. It's a difficult game Carney's playing because, I mean, he's told everybody that we're going to have new business from elsewhere. But the reality is, I mean, our border and the U.S. are still
essential.
A vast majority. Yeah, it's so important to us.
Well, we're planning my 4-year-old's birthday party in February, and this sort of disinviting friends seems very familiar with what's going on. And I mean, it's like, again, it is a game. It doesn't really matter. I don't even know what this Board of Peace is. I think most people would overlook it anyways. So, not to dismiss it as trying to fix what's happening in Gaza, but ultimately we do need to work together with the Americans. I think that there's a level-headedness in the private sector, certainly in both countries, and I think that this sort of ongoing political charade that plays out from the American side, I don't think is positive. I think Carney and what his government is doing, I think is trying to thread the needle as productively as possible. And I think, it's been a long time since you had Canada, at a global conference like that, sort of almost steal the headlines. And I think having a leader being able to communicate the economics of interests of Canada is something we definitely haven't seen in more than a decade. And so it's nice to see that, we have a leader who at least can understand the game better than maybe what we were seeing in the past 10 years.
Pretty much everybody, I'd say. So what, from an investment point of view, with everything that's unfolding, where do you look? What do you do?
Well, I think the one thing that is, again, a key theme from last year and this year is, I think you take tariffs but go at a bigger level. For all countries, there is this refocus on your core domestic economic priorities. I think where Canada can pivot, and you're seeing this in what was released in the budget, is the increase in defense spending and just getting to NATO target. And then I think the target is, or the goal is, to get up to 5% of GDP per year by 2035. Okay. Like, these are enormous levels of spending if they were to materialize. And I think but again, these are they have to go from being a budget document or parliamentary document to
actually happening.
Working with the private sector, getting investments done, and starting that process happening. And I think Canada, it's essential that we do that.
I got to wrap it up there. We got to get to a break, but always love having you on here. Up next, we'll take a look at the markets for the bell. Take a quick look at the markets. We'll start with the U.S. futures. It's been a turbulent week. Looks like it's going to end that way. You can see the Dow, NASDAQ, and S&P 500 all pointing down to start Friday. Over in Asia, mixed bag depending on where you are. The Nikkei up, Hang Seng as well, but the CSI 300 off today. Heading over to Europe, similar situation. You can see FTSE rallying, and it's up over 10,000, well above it now. And CAC 40's down slightly, while the DAX is up. And the TSX closing above 33,000 again, still not at the high from Monday, but up 0.46%. Some of the movers and shakers, let's take a look. Seabridge Gold, take a look at that, up by more than 12.6%. Discovery Silver up by 12 as well. Celestica off by 6.5%, and Lundin Mining struggling down nearly 11%. And looking at the metals, look at gold. It's going up again. It's pushing that 5,000 mark. Silver may hit 100 today, and copper is back in the green as well, up by about 2.5 right now. And oil, saw Western Canadian Select losing 3.4% yesterday. WTI today, what's it doing? There you go, up above 60 again, up nearly 2%. All right, time to see what's on the radar for Bryden Teich, CIO and Portfolio Manager at Avenue Investment Management. And one thing that's on everybody's radar, Lululemon. Everybody's talking about it one way or the other, it feels like, and you're liking it right now, even despite everything that's kind of unfolding.
Yeah, well, as we were just saying before we aired, I think it's an interesting business from the perspective of it's obviously had a significant decline from the highs from a few years ago. I think it's still down somewhere like 65%. So you've had expectations for the business completely collapse. At the same time, last year they did have, I think, on the 12-month basis, they had record revenues. It continues to be very profitable. I think there's enough things now positively inflecting for the business, or another way to say it is that all of the negative information is more than already priced in and factored in. And you've now had insider, or Chip Wilson come out, founder, essentially requests or suggests that the board needs to be changed. The CEO is leaving. You have Elliott Management who's come in as an activist trying to motivate the next CEO choice. So all of those things are starting to be incrementally positive. And at the same time, the valuation is somewhere 12, 13 times earnings. So expectations are really low. It's a super profitable business. All Canadians know the quality of the majority of their products. And at the same time, with the ability for them to do buybacks at this kind of accretive earnings multiple, that's attractive. And sort of on top of that, critically important is they don't have any debt. So you've got a strong balance sheet. So there's not a risk of Lululemon going bankrupt. They've always had a really clean balance sheet. So to buy a company with a good brand, very profitable, and all of these positive dynamics happening at a multiple like this on earnings, it doesn't really happen that often. Things could still get worse from here, and retail is very hard, so it's not to discount that. But I think at this share price, our view is that more than a lot of the negativity is already priced in, and probably too much so.
And with Chip Wilson being so vocal, and you've got Elliott, sometimes that's a bad thing, but can it be a good thing as well? Because sometimes it can stir the change that maybe the company needs.
Yeah, I think that, and maybe this is November or December, Chip Wilson did a one-page ad in the Wall Street Journal going through his laundry list of issues with the board and management. And essentially, he says, essentially they got away from product development and got too focused on, this sort of Wall Street trying to time the next quarter And really, for a retail brand or consumer brand like Lululemon to thrive, it's all about the product, and it's about the quality that you're providing to consumers. And if you can embed that in your consumer experience, you're going to have a good business.
Okay.
And I think they got away from that, and I think they're going to go back to that with it.
All right, I want to get the other one in. Toromont. What are you liking about
So
that?
Toromont is one that we've owned several years, but I think it was very much on this theme of Canadian infrastructure investment. And I think that our view is that there's going to be continued a positive direction in terms of investing within Canada, whether it's on the energy side, critical metals, infrastructure projects through Ontario and Quebec. Caterpillar has had tremendous results the past few quarters, and Toromont is the largest dealer in Canada and Ontario and Quebec. And so
as goes Caterpillar,
yes.
goes Toromont.
Yeah, and so I think that Toromont continues to be a really great business. And I think that directionally, there's now a much longer runway of infrastructure investments in Canada that is increasingly likely. The shares might be already reflecting all of that positive stuff because the shares did do pretty well last year. But as a long-term business, I think this continues to be a Canadian company that we really like.
Okay, we'll wrap it up there, but we have lots more to talk about coming up next. We're talking about crypto literacy with Preet Banerjee, founder of Your Money Degree. Stay with us. To invest or not to invest? That is the question when it comes to crypto. And now we're looking at some crypto literacy and why it's so important. Before getting involved in this, our next guest thinks the stakes are much higher when it comes to crypto. Joining us now is Preet Banerjee, founder of Your Money Degree. Preet, thanks very much for joining us.
Thank you very much for having me.
All right, for crypto, how much higher is it the risk when it comes to just stocks? I mean, we already look at the stock market sometimes as a bit of a casino. How much worse is it for crypto?
Well, Bitcoin, as an example, being the most popular cryptocurrency, is incredibly volatile, compared to a traditional stock and bond portfolio. So, if you go to a financial advisor and they ask you to fill out a risk profile questionnaire, something that would be off the charts aggressive would be something like a 100% stock portfolio. So if you would imagine that would be a 10 out of 10 on traditional risk scales, Bitcoin would be somewhere around 25. It would literally be off the charts. If you went to an advisor, say, yeah, I want to put 100% of my portfolio into Bitcoin. I mean, the chief legal officer, compliance officer, they would be calling you saying, are you sure you want to do that? That's how risky it is compared to traditional investments.
Hi, Preet. Good morning. One of the questions I had is we've now had a couple of these cycles of crypto. There's pre-COVID, the post-COVID cycle. I feel like we're in a different cycle now. But one of the things that starts to happen in these cycles is there's new coins, new protocols, new projects that gets adopted. And so what would you suggest people, or what would be resources that people can use to understand these different layers and protocols? And I think most people would be familiar, with Bitcoin at this point, but even Ethereum, Ripple, all of those, and the thousands probably now down. How do you think is the best way for people to sort of differentiate the different coins and protocols?
Yeah, it's a great question, and it actually comes to the central question when it comes to investing about, not in investing in things that you don't know. So it is important to develop, crypto literacy, even if you're not going to invest in cryptocurrencies of any form. And learning about crypto takes an incredible amount of time. There was a survey developed by some researchers to try to measure, what is the level of cryptocurrency knowledge out there, and the scores were horrific. According to this survey that was developed, the average level of knowledge on a score of 100 was 41. And even more shocking was that 15% of respondents, taken from a sample representative of the general population, 15% couldn't get a single question correct about the basics of cryptocurrency. So it takes a lot of time and research if you want to invest. And even if you do invest, there's a lot of market strategists, people who give advice on portfolio construction, who suggest that at most people should be putting 1 or 2% exposure to cryptocurrencies in their portfolio, unless you truly are a subject matter expert, which is incredibly rare.
I was going to ask about what percentage. With that, what are some of the things you're looking for when it comes to putting your money somewhere?
Well, I'll tell you, I'm actually looking for people to be a lot more aware of the scams involved with crypto. And here's why I say that. I have personally been inundated this last week with emails from people saying, hey, I saw this ad on name your favorite social media platform, saying that you have partnered, me personally, have partnered with Prime Minister Mark Carney to create a wealth shield to protect people from crypto scams. So the reason that I am now part of these scams is because I put out, a little Instagram reel warning people about the Mark Carney Bitcoin scam. And this was something that has been going around, luring people, pretending there's a deep fake video of the Prime Minister promoting Bitcoin. And a lot of people got scammed. And so I tried to raise awareness of that. And now, because scammers are so sophisticated, they're now using my likeness and saying that we've teamed up to create something to thwart these scams, which is in itself a scam. So my core message to a lot of people is, because I hear about this all the time, I hear more about people getting scammed and losing money from crypto than I do people who properly put it into a portfolio. If you do want to put it into a portfolio, it should be part of an investment policy statement that takes into account the incredible volatile nature of it. And a very small allocation is what you would start at if you need to start. And a lot of people, again, if you don't understand it, you don't need to invest in it to be a successful investor.
One other thing that we've seen in this last few years is increasing institutional adoption, whether that's through the larger ETFs for either Bitcoin or Ethereum. You're also seeing institutional adoption become much more normal or sort of normalized than they would have been 5 years ago. So what are you seeing in terms of that as a theme going forward? And then on top of that, as you just touched on, there seems like a regulatory hornet's nest for these scams going on. And how do you think the regulators are managing through this, or are they able to in any way at all?
Yeah, it's a great question. With respect to institutional adoption, this is completely antithetical to all the early evangelicals about cryptocurrency who wanted everything to be decentralized without oversight. And I think what we've seen is because so many people get burned when there's a gap between the access, so a lot of people have access to it 24/7, and the knowledge. There's a huge gap there. And that basically leads to two things: people being taken advantage of, and bad actors coming to the forefront to take advantage of this gap. And so on one hand, with institutional adoption, you get some kind of validation. You're going away from the first principles of what cryptocurrency was all about in the first place. But if it is going to be part of the investing ecosystem, then that's sort of a necessary step, because people do want oversight. They do want the ability to have recourse, and there needs to be some heightened level of regulation. What's really changed a lot in the last couple of years, everyone thought that with this new administration in the United States, this was going to more further legitimize cryptocurrency as a whole, because they were very cryptocurrency forward. But the level of scams have increased. And, if you have the president of the United States going on and encouraging people to invest in his own coin, then when people see a deepfake of the Canadian Prime Minister touting Bitcoin, which was completely fake, is a scam, that also gives those scams a sense of legitimacy to people who don't know any better. So it's a very tough thing to police, and very tough thing to regulate.
Okay, we have to wrap it up there, Preet, but thank you very much for joining us. We appreciate it.
Thank you very much.
Preet Banerjee is founder of Your Money Degree. Just ahead, we're breaking down Canada's November retail sales numbers as they're released in just a few minutes. And of course, our phone lines will open up for our first call segment. You can reach us at 1-855-326-6266. Send us an email as well. First call at bellmedia.ca. U.S. President Donald Trump has disinvited Prime Minister Mark Carney to join the Board of Peace, a U.S.-led effort to oversee the reconstruction of Gaza after years of conflict. Trump made the announcement in a Truth Social post. The invitation withdrawal comes days after Carney delivered a speech at the World Economic Forum, warning against coercive tactics by the world's great powers. China's ambassador to Canada says allowing a limited number of Chinese electric vehicles into the country could lead to new auto jobs and cheaper cars. The comments come as Ottawa faces criticism over a deal signed by Prime Minister Mark Carney and Chinese President Xi Jinping. Ontario Premier Doug Ford recently urged Canadians to boycott all Chinese EVs. Ford says the vehicles put thousands of auto sector jobs at risk. Shares of Intel are dropping in the pre-market. They're off by 13% right now as the company struggles to keep up with surging demand from AI data centers. Intel also issuing profit and revenue forecasts for its current quarter that were below expectations. The chipmaker citing manufacturing problems and supply chain constraints. The decline follows a strong 2025 when Intel's stock rose nearly 50%, boosted by major investments from SoftBank, NVIDIA, and the U.S. government. And quick peek at the U.S. futures right now, and it's been a little bit of a rock and rolling week, and it's going to continue that way into Friday. You can see they're all in the red right now. Well, Stats Canada just released November retail data for it coming out today. A few minutes ago, actually, retail sales increased 1.3% to $70.4 billion in November. Sales were up in 8 of 9 subsectors, led by increases in food and beverage. Here to talk about the numbers is Randall Bartlett, Deputy Chief Economist at Desjardins. Randall, thanks very much for joining us.
Oh, thanks so much for having me.
Okay, just a general overview, your thoughts on that number and how the rest of it looks.
Yeah, I would say it's unambiguously a positive number for the Canadian economy. When we look at what was under the hood, we see, as you mentioned, 8 out of 9 subsectors were up in the month. We saw a rebound in some sectors that fell pretty sharply back in October. Things like sales at food and beverage retailers. So that's good news. Ultimately, core sales up 1.6%, retail volumes up 1.1% in the month, and so overall a pretty good print. And I think that it tees up hopefully better news to come.
Good morning, Randall. On the momentum of the Canadian economy, we've sort of, through the challenging beginning of last year, it seems like we've kind of got to a sort of stall speed but positive growth. I think this number kind of feels consistent with that. But I'm wondering where you think this might increase or decrease the impetus of the Bank of Canada from here. And have they made clear that they're kind of now, pause and going to hold for a while? Because the economy doesn't seem to be deteriorating, and at the same time, it's also not reaccelerating. And so we're kind of in this stall speed moment, it feels like.
Yeah, I think that's a great way of characterizing it. I think this isn't really going to move the Bank of Canada at next week's meeting, and we think the bank is likely going to hold. And I think it's telegraphed that pretty clearly. And today's retail release isn't going to move that all that much. We've seen that retail sales have really just sort of been in a bit of a zigzag pattern sideways throughout the year after a very strong acceleration in 2024. So ultimately, Canadian consumers, spent a lot last year. There's a lot of reasons for that. HST, GST holiday, motor vehicle rebates, particularly for EVs. And so ultimately, Canadians, given all of the uncertainty and the relative weakness in the labor market, we've seen Canadians just sort of, stay on the sidelines, not really cutting consumption and retail spending, but also not increasing it either.
And is this a case on some of them? I saw looking at Alberta motor vehicles, parts were up. Is this people finally they held off and now they're taking the plunge, they have to get these things?
Yeah, it's really tough to say whether it's sort of a one-off in the data or whether it's is a reflection of broader economic trends. Certainly, it's I would say it's a positive given sort of the weakness in the motor vehicle sales that we've seen sort of in the middle part of the year as people tried to get ahead of the retaliatory tariffs that were on early in the year on imports from the U.S. We saw a lot of motor vehicle purchases. Ultimately, that kind of dried up in the middle part of the year, and so hopefully it's a harbinger of some positive momentum on that side of things. But overall, I think that sort of stall speed and consumer spending is really where the Canadian economy is at right now. When we see that inflation remains still better than the Bank of Canada's 2% target, just slightly north of that. We see that particularly food inflation remains quite elevated in Canada. So households are still feeling a bit of an affordability squeeze, and so we think that's probably being reflected in those retail numbers as well.
One of the highlights from the budget last November was that increasingly it looked like Canada and the federal government was going to look at increasing defense spending and sort of pivoting to this sort of industrial policy and encouraging investment from the private sector. I'm wondering if you're seeing any sort of either directionally positive things within the private sector that would be consistent with the baton starting to be handed off. And I think Carney's speech in Davos this year, or last week, or this week, is getting a lot of attention. But I'm just wondering if you're seeing any positive signs from the private sector of actually now, heading into the next phase of this.
Yeah, one of the tough things in trying to read the signals in the data right now is that there's so many conflicting forces hitting the Canadian economy, particularly when it comes to the investment side of things. So you've had all of the uncertainty created by the trade war, plus now in 2026 we've had the regime shift in Venezuela, ultimately putting downward pressure on heavy oil prices in Canada. So ultimately that's going to create more uncertainty when it comes to investment in the energy sector as well. So my sense is that the federal government is doing a lot of the right things, trying to provide support for private sector investment, reduce the time for evaluation of projects, try to harmonize regulations across provinces so there's not duplication. It's one project, one process. And so I think the federal government is doing a lot of the right things to create a positive investment environment in Canada, both for domestic capital and international capital. But the challenge is that it's up against significant external headwinds, really not of our own making as a country. So I think we're headed in the right direction. The question is ultimately which is going to win out the day in terms of the external shock that's coming largely from the U.S. or the support that's being provided by the federal government, both on the cutting red tape and in terms of using its fiscal firepower as well.
Just looking at one of the numbers I found interesting, retail e-commerce sales in Canada were off by 2.8%. Any indicators as to why? Does that tie in with not ordering from the U.S. or people just decided to go out and buy things?
Yeah, it's an interesting number because these are seasonally adjusted data, and so they're trying to remove some of the seasonal patterns that we see. But November data will pick up Black Friday sales, and so ultimately, we've seen this move toward buy Canadian and away from Canadians purchasing goods from the U.S. And so, no doubt, this is probably getting picked up in this data. It's kind of tough to tease out what is the different causal factors here, but we've seen that e-commerce has been relatively weak recently, and so I think it really is partly a function of this buy Canadian tilt by consumers here in trying to support Canadian businesses that have been hit by the trade war with the U.S.
And I think I just want to sneak in one more question. We're almost out of time, but the advanced retail indicator is looking at a decrease for December, 0.5%.
Yeah, I mean, again, this data sort of had this zigzag pattern moving sideways recently, so not really a big surprise there. We'll see how the numbers shake out ultimately, but I would say StatCan's flash estimates have been relatively close to the number that we see at the end of the day. It covers the December number covers over 60% of retail companies surveyed, and so ultimately, the number should come in fairly close to that in my view.
Okay, we have to wrap it up there, Randall, but thank you as always for joining us.
Oh, my pleasure. Thanks a lot for having me.
Randall Bartlett is Deputy Chief Economist at Desjardins. Still ahead, U.S. President Donald Trump has said that his new Board of Peace was withdrawing the invitation to Canada to join. Bloomberg's Tyler Kendall will be here to break that down next. And of course, our phone lines are open. Bryden Teich, CIO and Portfolio Manager at Avenue Investment Management, is taking your questions on stocks. Call us at 1-855-326-6266 or email firstcall@bellmedia.ca. U.S. President Donald Trump saying that his new Board of Peace was withdrawing its invitation to Canada to join them. This just days after Prime Minister Mark Carney delivered a withering speech at the World Economic Forum in Davos, warning against coercive tactics by the world's great powers. And it is garnering all kinds of reaction, like we just saw from the president. We're joined now by Bloomberg's Tyler Kendall in Washington. Tyler, thanks very much for joining us. Are we getting more details on that withdrawal, or it was a pretty curt note, wasn't it?
Right. Good morning, Roger. It was, and it came after, as you mentioned, we saw this pretty stunning speech from the Canadian Prime Minister, Mark Carney, where he didn't mention President Trump by name, but it was widely considered to be a scalding rebuke of the Trump administration, particularly related to the tariff policies. Now, beyond President Trump revoking this invitation to the Board of Peace, of course, another main point of what we saw come out of Davos, we also saw President Trump take his own aim at Mark Carney in his speech at Davos, related and alluding to defense spending and security in the region. And that was interesting because President Trump had singled him out. He wasn't afraid to invoke Mark Carney's name, whereas we saw perhaps more of an allusion to it in Mark Carney's speech. But as you well know, this is just the latest escalation in what has been an increasingly tense relationship. And it really feels like we're getting sort of a tit for tat in the recent weeks. But I don't need to tell you that this has been mounting at this point for months. Of course, we know that there has been some frustration when it comes to the lack of progress on a trade deal. While there is a lot of protections under USMCA, we know that there has been some concerns over those sector-specific Section 232 tariffs, in particular related to steel and aluminum. And that has led Mark Carney to say that he is looking elsewhere for those trade deals, including with China, inking a deal just last week where he said that China was a better trading partner than the U.S., more predictable in his words. And that has, of course, drawn the ire from U.S. officials here that are saying that they are unhappy with what appears to be this more of a tilt to China from Canada, because that has been a consistent position of this administration as they look to strike these trade deals in a bid to bolster against Beijing's influence.
And CUSMA negotiations, or USMCA, depending on how you want to spell it or say it, are coming up. What do U.S. officials think as we head into that?
So at this point, it's been interesting to watch how President Trump has sort of done this perceived indifference, I think it is fair to say. We saw the other week he was touring a Ford Motors factory plant where he called it irrelevant, and that has spiked some concerns about what this could be in terms of a lengthy negotiation process, since we know that this is up for renewal on July 1st. And we heard from the Commerce Secretary Howard Lutnick yesterday. He was speaking on Bloomberg Television with my colleagues in Davos, and he said that Canada's movement towards China could actually complicate matters further. I had reporting on the Bloomberg terminal last week when we saw the USTR Jamieson Greer meet directly with automakers in some key battleground states here in the U.S., including Ohio and Michigan. And it does appear that the administration is courting the automakers' views, since we know that this is an integral part when it comes to the USMCA agreement. So it's something that we're going to have to watch carefully here moving forward, considering this is a deal that President Trump had negotiated under his first term, but it now appears that he is pulling back from it, saying in part that his criticism is linked to his views that it is more beneficial to our partners than it is to the U.S., sort of advancing what we have seen as that more populist messaging from the president. And I wouldn't expect that to let up over the summer during the negotiations, because we are going to be heading straight into the midterm campaign season.
I know we're only in January. All right, Tyler, thank you for that. Bloomberg's Tyler Kendall in Washington. Still ahead, we'll take a look at some of the notable analyst calls and recommendations moving the markets, including Starbucks. Let's take a look at some of the notable analyst calls and recommendations. First up, Starbucks raised to outperform from market perform by William Blair analyst Sharon Zakfia, who cites the likelihood of sales and margin recovery further buoying the stock. The stock is up ahead of the bell. Zakfia expects Starbucks to post its first domestic comp sale gains in 2 years in the December quarter, which should set the brand up well for a return to positive full-year comp gains in fiscal 26. She also expects more detail at Starbucks' inaugural Investor Day under new leadership on the 29th. And then there's Procter & Gamble. Shares are up in pre-market trading after J.P. Morgan upgraded the consumer products company to overweight from neutral. The move comes in the wake of the company's results in the earnings call. The company, quote, gave much needed and hope for reassurance that the company is on the right track to sequentially improve organic sales growth, says analyst Andrea Teixeira. Price target is raised to 165 US from 157. Let's bring Bryden back in. He's the CIO and portfolio manager at Avenue Investment Management to get some thoughts on either of those companies. One you like more than the other, or not like more than the other?
I have to comment on, I love the analyst language of sequential growth on a comp, quarter over quarter to improve year-end comp. Like that is sort of, it epitomizes the focus on sort of these short-term moves in earnings and business performance from companies. I think if we were to part those two, I think Starbucks has been challenging. A lot of their growth from the last decade was in China. They've retreated from that in the past couple of years, and I think
they got right out of owning outright, right?
Yeah, so I think it was really a China growth story, which then they've refocused on the domestic North American economy. I think it's a great brand. The challenge is it's just not necessarily a growth business anymore, and you've sort of seen a challenging share price as the market sort of reflects that now in the valuation. I think Procter & Gamble is a great business. The challenge for some of the consumer products is they've always been expensive and not that big of a growth company, but it is on store shelves. They have essential products that everyone needs. Procter & Gamble is generally a more defensive stock. So in a hot market, it's not necessarily the kind of company you want to own, but it's a long-term sort of sleep at night kind of investment. It's one that people can think of. We don't own it, but it's in the category of great companies. And I think they've struggled too with rising costs. And I think from the analyst note, they're trying to sort of right-size that.
What would make you want to own it?
I think a much cheaper valuation. I think there's so many other compelling areas of the market where you can find growing businesses that don't have that kind of multiple of earnings on that. And Procter & Gamble is a great business, but there's other compelling businesses like we talked about Lululemon in the consumer space that I think offer much better risk reward here.
Okay, we'll leave it on that note there. When we come back, Bryden, who's the CIO and portfolio manager at Avenue Investment Management, is going to take your questions on First Call. All right, time for First Call and first email, and that's coming in from Dave, who says, can I get your guest's opinion about getting more defensive, and could he recommend a couple of stocks he would consider at this time? That's from Dave.
Sure, so thanks for the question, Dave. So I'll take that question to be more about defensive stocks in the market rather than actual defense stocks. But I think, in a market like this that has had a huge run, I think anywhere that you can get a little bit of a dividend yield with some stability, I think is an attractive place to be. One name that we have in our portfolio is Choice Properties, which is the underlying real estate of Loblaws. It's a great business. They own great assets. It pays a very stable dividend yield. I think some of the sectors of the real estate market have had a better 12 months in the past year than a couple of years ago. But Choice Properties would be one of our bellwether defensive names that you can sleep well at night owning. And it's a very defensive name to own.
Now, do they own the Loblaw properties, or do they own beyond that?
So they have beyond that. They do have some commercial and other industrial businesses. They did an acquisition maybe 10 years ago to diversify the business, because when it first came out, it was exclusively Loblaw's properties. And I'm not sure the exact number, but Loblaws would probably still be close to 3/4 or more than 2/3 of the business. So it's underlined by very stable, grocery-anchored properties, and the Weston family is a large shareholder of Choice. Loblaws, the company, is a large holder of Choice. So you have very aligned shareholders, and you have a very consistent dividend that you can rest on.
All right, let's move on. This email is from Al, and he says, what's your outlook on CIBC?
Thanks for the question, Al. So
the banks,
CIBC has done very well in the past 12 months, and really the bank sector as a whole has had a really good run. And I think.
And what does that set for if you'd had it for the last 30 years, it's outperformed the market, right?
Yeah, I mean the banks in Canada have done a phenomenal job. Obviously, it's an oligopoly structure, so there's profits for everyone, and we've had I think the thing on the banks were, personally, and at Avenue we were a bit lighter, but my own personal views were definitely wrong on the banks a couple of years ago, where I was more concerned that we were going to have a down credit cycle in real estate, which I think really would have affected the banks. We don't own CIBC, but we do own National Bank. It's been one of our larger positions for the last several years. We like the growth in National, and some of their businesses are higher return, more fee business than the traditional lending business. But as a whole, all the bank sector has done well. I think, again, the challenges here, as we talked about with the Desjardins economists, you're really at a stall speed growth for the economy. And if you do have a recession, I think, I don't think that's great for the bank stocks. But I think even if you have a mild recession, I don't think we're looking into the, over the cliff in terms of a economic contraction, which if that were to occur, that would really hurt the banks. But they've had a good run, and I think that run needs to be respected. And they should be part of everyone's long-term portfolio in some way.
We're going to sneak in one more question here. An email from Robert that says, can I have your guest's opinion on Brookfield?
Thanks,
which
Robert.
Is kind of all-encompassing.
Thanks for the question. So Brookfield is another great Canadian business. I think the challenge for Brookfield and the whole private asset, private equity, private credit market is that you've started to see some cracks in the last couple of quarters with some private funds having issues. I think the issue is it's just a very highly leveraged business. And if you do have concerns about private equity or private credit, I think as a theme that will hit Brookfield. But as a long-term business and asset owner, I think they're as good as it comes. So if you're a long-term shareholder, it's something you can be comfortable with. But I think over the next 12 months, you might have some headwinds because these concerns about private equity and private credit, I don't think are going anywhere.
So maybe just tuck it away and don't look at it.
Yeah.
All right. Well, we have to leave it there. That is it for us here on The Street. Bryden, thanks as always for joining us. Appreciate it. Bryden Teich, the CIO and Portfolio Manager at Avenue Investment Management. And coming up next, Andy's up with the Open. The markets will open about 30 minutes from now. Have yourselves a great day and a great weekend.